Interesting trend going on in big oil. Companies like Exxon and Shell and BP, they're all trying to use low oil prices to renegotiate and to restructure to get their costs lower. The idea is to go from making a little bit of money at $80 a barrel to making a fair amount of money at 70 and to drive down your break-even point even lower. And this is not good news for the suppliers of drilling services or seismic data because everybody's trying to renegotiate all this stuff lower. But it's interesting if you then look at the oil companies and say, okay, if that's the trend, lowering your costs so that you get your return on capital up, who do you want to go with? Do you want to go with the guys like ExxonMobil, which has the highest return on invested capital of anybody in the big oil sector? It's, if I can look at this, about 14%. In comparison to, say, the laggards, Chevron is up there near Exxon at about 11. I think that's going to go higher as some projects come online. But the laggards are people like Statoil and Total and Eni, and they're all down near 3%. So the question is, who's going to have an easier job of cutting costs and getting their return on capital up? The companies that are already showing these very, very large return on invested capital, like Exxon at 14%, or the laggards down where Total is and where Statoil is, which have been running relatively inefficient or at least relatively expensive production programs and exploration programs. So it's the standard bet between value and growth. In this situation, I would think that some of the European companies like Eni and Total, Italian and French respectively, or Statoil, Norwegian, I think that those companies are probably a better bet for cutting costs. And if you're looking for some way to make a profit out of this trend, that might be the end of the big oil sector that I'd be looking at. This is Jim Jubak for Jubak Asset Management.